Was a close call. That is the main headline from the minutes of the Fed's last policy meeting. And that decision, you'll recall, on September the 21st, kept the benchmark rate at a quarter point with a vote of 7 in favor and 3 dissents. But the minutes here reveal a much more divided Fed than a vote of 7-3 would suggest. And here's a direct quote. Among the participants who supported awaiting further evidence of continued progress toward the committee's objectives, several stated that the decision at this meeting was a close call. And here's more. Several voting members said it would be appropriate to raise rates, quote unquote, relatively soon. So what's all the fuss about? The fuss is about labor market slack. The 3 dissenters who wanted to raise rates at the last meeting believe that conditions in the labor market are already tight. Keeping rates easy pushes unemployment to an artificially low level, that's what they believe, sparking an inflationary fire that could force the Fed to hike so fast that the economy tips into recession. The other side of the argument, and the one you could say that's winning so far, is exactly what we heard from New York Fed President Bill Dudley this morning, that there is still slack in the labor market, and keeping rates low will draw more people into the workforce. Of course, it all sounds very dry and perhaps very academic to some of you, but there's a whole lot at stake. Several people in that room raised concerns about the Fed's credibility. A few worried that there's already too much leverage in the economy. And one made the argument that we've been hearing from Larry Fink, from Bill Gross, and others, namely that low rates are crushing pension funds and paradoxically causing some investors to save more when the Fed wants them to be spending. Does this mean that the Fed is going to raise rates on November the 2nd? That's, of course, what matters most. Probably not. Why? Well, here's one reason. The most recent jobs report the other day showed a big jump in the labor force, and so maybe Bill Dudley and Janet Yellen are right that it is okay to wait. Either way, the case for a rate hike would have to be overwhelmingly strong for the Fed to move 6 days before the federal election. Oliver, that's the story from the Federal Reserve right now, a reading of the minutes of the September 21st decision, a divided Fed.
Divided Fed, that is definitely the story. That's Bloomberg's Eric Schatzker in D.C. Eric, thanks so much. You can also follow along with all the breaking news related to the minutes on Top Live. It's on the Bloomberg T Live Go. You can just see here some key quotes that we're getting from the minutes here. Several members judged that would be appropriate to increase the target range for the Fed funds rate relatively soon. So you see some of the dissent there that Eric was just walking us through. Also kind of bleeding it over into markets as you look through and kind of see what's happening with some of the dollar here intraday as well, with a little bit of weakness there. Also moved down in the Treasury yield in the 10-year. So follow along with T-Live right there. You can catch all the updates as they come along. Now, let's check on the market reaction with Abigail Doolittle. Abigail? So
the Fed may be divided as to whether or not rates should be raised and when they should be raised. The market reaction, though, is really not too great, Oliver. We still have U.S. stocks basically unchanged. The Nasdaq flipping slightly lower, but that's been the story of all day, fluctuating between small gains and losses. Let's see if bonds agree, if basically investors are viewing the odds of the Fed probably raising rates in December. And we are seeing the yields still higher after those minutes release. So this still suggests that investors believe that there could be a better than not chance that rates will be raised this year, likely in December, according to Warp. Now, we go into the Bloomberg and we take a look at #BTV 3422. This chart supports that idea. This is a 3-year chart of the 10-year yield. We see a downtrend on the extraordinary policy of rates being kept so low for so long. But most recently, we see the 10-year yield climbing off of that Brexit bottom, climbing perhaps to the top of the range, suggesting that we could see the 10-year yield climb back closer to 2%. So this longer-term chart does suggest that the Fed may be on track to raise rates this year. As for the dollar index, it was higher going into those minutes, and it's still slightly higher for its 3rd day in a row. So another asset class here where we're really not seeing much of a reaction. And finally, in the commodity complex, lots of weakness for commodities today, including oil, natural gas, gold, and futures, and that is still the same, really has not changed very much from those Fed minutes. So lots of anticipation, but maybe one of those situations, Oliver, Matt, when we say much ado about nothing, not too much new came out of those minutes as far as the markets are concerned.
Right. A little bit more fluctuation and not a lot of big stuff. Thanks a lot, Abigail Doolittle.
All right, I want to get more perspective on the latest minutes from the Fed. Randall Krasner is a former Federal Reserve governor himself. He's now a professor of economics at the University of Chicago Booth School of Business, and he joins us from our bureau there in Chicago. Randy, thanks so much for joining us. Let me first ask your reaction to what I'm not going to say mutiny, but there definitely is a big debate starting to stir in the Fed, and the chair sits clearly on the dovish side.
So I think it's very clear, both from the vote before as well as the discussion in the minutes, that there are a number of people who want to be moving sooner rather than later. And what's very interesting is someone like Eric Rosengren, who had been very favorably disposed towards keeping rates low for such a long time, is now one of the people dissenting and saying that we really do need to move. Not only some of the labor market issues that you were discussing are some of the pressure points, but I think there are these broader issues on financial stability that Eric has raised and that I also have some concerns about.
We do see, though, or we don't see really a lot of inflation, and we haven't seen inflation rear its ugly head in so long that I think a lot of people, not necessarily people as sophisticated as Federal Reserve economists, but a lot of market participants find it hard to believe that we could see the economy overheat even if rates were kept lower for longer.
Well, for sure, right now we're seeing inflation below the Fed's 2% target. It's been there for a while. Inflation expectations have actually come down. I mean, the best type of central bank policy is one that is looking through the front window of the car rather than looking through the rear view window of what's happened in the past. So they want to be ready. But I think it's not only some of these inflation pressures, but also some of the financial stability considerations, thinking about what are the consequences of having interest rates low for so long. I mean, when I was there, it was at the end of 2008, beginning of 2009, we brought rates down to zero, or effectively zero. Included that phrase, for some time, which then became considerable period. Nobody thought that was going to mean 2015, 2016, 2017.
Randall, when we talk about that, looking out the front window, as you said, instead of the rear view one, looking ahead, we obviously focus a lot about what's going to happen at the next central bank meeting or the one in December, and that's kind of what we focus on. But we look at the path. What do we know right now? What does all this dissent mean for the slope, sort of talking about the path going forward for rates? What is that going to look like?
So I think it's still going to be a gentle path, and that the infamous dot plots that come out with the Fed statement of the dots of where each of the members of the Federal Open Market Committee say that they think rates are going to go, that's become more and more gentle over time, and I think it is still going to be gentle. So I think one shouldn't mix up the extent of dissent with the extent of ascent of the rates. I think they will move up in a gradual, gentle way, but I do think people want to get started sooner rather than later.
How important is it? I mean, we know that there are 5 governors and the president of the Bank of New York that vote, and then 4 others that rotate through 11, leaving 7 regional Fed presidents who don't vote, but still, you know, how important are their views when they speak at these meetings?
I think Janet Yellen, as well as Ben Bernanke before her, really tried to build a broader consensus, and so it wasn't a focus just on who's voting and who's not voting. It was really what are people seeing, what kind of analysis are people giving, and where is the broad consensus of the committee. So I think it's a little bit too narrow to focus just on the voting members. I mean, formally that's where the decision is made, but I think it's really a broader committee kind of decision that is made, and it's really the substance of the arguments.
Well, how important is it then to Fed Chair Yellen to build a consensus? Because with this kind of distribution, or this kind of dissent, it doesn't seem like she's very close to that.
Well, in some sense, I think she wants to move soon, but not immediately. And so, in certain ways, this is helping to build, maybe not within inside of the Fed, but within market participants, to see that the probability of rate hike is highly likely by the end of the year. I think this, in certain ways, that's a very effective way for the chair to be able to convey that and to say that it was a close call. We had 3 people who wanted to move now, 3 voting members, and so the likelihood of a move by the end of the year is quite high.
Randy, you were on Bloomberg Radio in August, and at that point talked about how it looked like the move was going to come by the December meeting. I just want to look real quickly at the terminal here, looking at the world interest rate probability path. This green line right here, essentially, it's pretty much close to showing that now the market has gotten pretty much on board with that. Quite a big surge. At 70% right now, about 2/3 of the market thinks the Fed is going to go in December, which is basically the highest almost ever, really, since January. What do you make as sort of the reasoning for that? Is it the dissent, or is it the more sort of fundamental economic picture that's improved that's driving those odds higher?
Well, I think the dissents are largely reflecting the economic conditions, so I think they're kind of part and parcel of the same thing. And communication is always a challenge, and you don't want to go too far to get the markets to suddenly explode upwards. I think they've been able to raise the expectations of a move by the end of the year. The dissents are consistent with that. The minutes are consistent with that. Now, of course, something could happen between now and December. But unless there's some major shock, I think they're pretty much on track to moving by December, as I had said this summer.
If we look at the dollar, we're at a 7-month high right now. Obviously, as the chances, as we get closer to an increase, that's going to climb a little bit. Does that hold the Fed back a little bit, the strength in the dollar?
I think the Fed understands that what the consequences are of raising expectations of tightening and of raising rates when most of the rest of the world is going the opposite direction. And so certainly the dollar has strengthened significantly against many other currencies. And I think the Fed understands that and has taken that into account in deciding that the economy does seem to be robust enough to be able to move ahead.
All right, Professor, thanks so much. Randy Krosner there, former Fed governor, professor at the University